I'm here with Simon Smiles, who is the Chief Investment Officer for ultra-high net worth clients at UBS Wealth Management. And we're here to talk about what those clients who have around $100 million or more in assets, what they're doing with their cash. So, Simon, what are they doing with their money?
Well, there's a lot of cash. Our clients continue to be over-allocated versus what we'd recommend in cash. Secondly, there continues to be a high degree of home bias. Typically, clients still have more of their money allocated into the assets that they feel more comfortable with, if you will, than we'd recommend. The third area, which we're definitely seeing, is an increasing interest in longer-term themes, looking over a 5-10 year period, typically in private equity or direct investment.
Why is it that people are still sitting on these cash balances?
I think it's probably still a reaction to the crisis we saw in 2008 and 2009. Liquidity was king then, and so even 5 years on from the crisis, our clients still want a significant proportion of their portfolios which are highly liquid.
And for those who are investing, what parts of the world are they investing in? Are they interested, like everyone else is, in getting yield, and what kind of instruments are they buying to get it?
Definitely interested in yield. Unfortunately, yield is very hard to find these days, with 8 of the 18 countries in Europe now having negative interest rates for at least 2 years. So in that context, clients are looking increasingly to the US. They're looking to US equities, they're looking to US high yield, and indeed the US dollar to try and redeploy their investments.
And you said that earlier this year people were more interested in Europe, but that's faded somewhat.
Definitely. I think we started the year with a clear preference, not just among our European clients, but also our Asian clients and our US clients for European assets. Unfortunately, that was predicated on a dual hope. A hope that economic growth would return to the region and a hope that corporate earnings would start to grow. I think 8 months now through the year, both of those hopes haven't come to fruition, and people are increasingly giving up on the positions.
And in terms of geopolitical risk, what is top of the worry list for your clients?
The conversations I'm having are generally about why geopolitical risk isn't having more of an impact on wider financial markets, given it's not just Ukraine and Russia, it's also the events in Syria and the north of Iraq, and what's going on in Gaza. The simple answer to that is none of these events have actually had an impact or material impact on the oil price. With oil continuing to fall and being close to a 3-year low, then that normal mechanism by which geopolitical risk derails wider risk assets and the story for equities, the oil price, simply hasn't been affected.
And are the geopolitical risks a factor in why people are sitting on so much cash, or is that just a background story?
I don't think it's the main factor. The cash levels that we've had in client portfolios in aggregate haven't largely changed over the last 5 years. They definitely haven't become more elevated just over the last 6 months.
Okay, Simon Smiles, thanks very much.